Today, we are discussing rollovers for business startups, or ROBS. In short, ROBS will teach you how to use your retirement funds, tax-deferred, penalty, and debt-free. This innovative resource has become the fastest growing form of funding to help someone start, acquire, or grow a business. Two ROBS experts have created a series of comprehensive educational videos to help you become an educated and successful entrepreneur. The first, Larry Carnell, is the National Award-winning Entrepreneur of the Year, business and franchise expert, and Vice President of Benetrends Financial, the company that discovered this legal pathway in 1983. Carnell is recognized as one of the country's foremost ROBS experts and is credited with helping introduce this creative funding, wealth-building protection program. Joining Carnell is CPA Gary Bodie. Bodie holds a master's degree in accountancy and is considered a leading national expert on ROBS structures. He is also a business lecturer and contributing author on ROBS and C Corporation structures, which can help maximize your exit strategy benefits while minimizing your taxes. In addition, Bodie runs his own practice where he advises and works with entrepreneurs with ROBS structured businesses across the United States. How does one avoid the risk of double taxation on C Corporation profits?
On every ROBS phone call that I receive, inevitably people will ask about double taxation in a C Corporation. Non-accountants, non-financial people don't really understand a lot of the tax entities that are allowed, and they hear these scary things about C Corporation double taxation. And sometimes it's better to leave money in the corporation because the first $50,000 currently is only taxed at 15%. But what we do is take an extrapolation, say you have a calendar year, fiscal year, and I'll go ahead then and clean up the books as of the end of November, extrapolate December, come up with how much profit there's going to be, and then devise ways to get that profit out. Now, typically, with the first or second year, that's a bonus check. However, once you get to the point where you can cover your personal living expenses with a regular salary, then any profit can actually go back directly into the master plan,
retirement plan.
Retirement plan, depending on the owner's view of how employees are to be treated.
Right.
There's a continuum, but you have to do whatever you do for yourself, for your employees. But structurally proper retirement plan, you can make direct deposits right into your master plan and come up with owing no taxes.
Yeah, and that's the reason a lot of C corporations have retirement plans, to be able to shift the funds rather than even paying the corporate tax, move that money directly into the retirement plan and totally avoid any taxation. Of course, the key issue there is having a vehicle where 100% of the stock, not part of the stock, but 100% of the stock is actually owned by the retirement plan. If you have any personal ownership, then you're often automatically exposing yourself to the risk of double taxation.
And your plan is one of the only ones that allows that.
Yeah. Right now, because keep in mind, we're not simply a finance firm. The industry is really only full-service retirement plan design firm. So we custom design plans with your exit strategy in mind, not just funding a business, but specifically on the accumulation, acceleration, protection of wealth, and tax mitigation. But I think that pretty much addresses double taxation. Our next video will be on ROBS 6, choosing a CPA.
Okay.